Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to the Behind the Advice podcast. In this episode, we're diving into how to optimize your tax and finances as an Australian expat living in Canada. So whether you're planning a move to Canada, already living in Canada, or planning a return home to Australia, this episode is designed to help you make the most informed financial decisions as an Australian expat living in Canada. So some of the key areas we'll explore in this episode include understanding cross-border tax obligations, managing assets in both Australia and Canada, and then avoiding some nasty tax and financial pitfalls when returning home. Our guest on this episode is Jonathan Bell, a CPA and Chartered Accountant at Phillip Company, who is based in Ontario, Canada. Jonathan has a large cohort of Australian expat clients in Canada that he helps through his specialist cross-border tax services. Thanks for joining us on the podcast today, Jonathan. How are you?
I'm doing well, Mitchell. Thank you so much for having me on. I appreciate it.
Excellent, mate. And I appreciate you joining quite late your afternoon. You're kind of winding down your day, and I'm kind of just cracking on.
Right. That's right. Good morning to you, Mitchell. That's right.
That's right. The time differences aren't the most friendly between Australia and Canada, so I'm glad we could make the call work.
Absolutely.
So tell us a little bit about your background as an accountant in Canada.
Okay, so I'm originally from the UK, as you can probably tell from my accent. I qualified as a chartered accountant in Canada, in Toronto, in Canada, and then we ended up. They merged us to be CPAs, so I'm now officially a CPA. Sure. I started my working career at KPMG in Toronto, spent a number of years there, and then moved to a small practice based in Toronto. Where I've been for the last 20 or so years. We're basically now a remote firm. Mm-hmm. So I have clients all around the world, across Canada, mainly across Canada, but at this point, pretty much anywhere in the world, helping clients with their Canadian taxes. And we mainly have individual clients, but we do a lot of businesses, a lot of tax planning for the owner managed businesses.
Yeah, excellent. Super exciting. How did you kind of come into working with Canadians living all around the world?
So I ended up with, I guess my specialty really is dealing with clients who have tax residency issues in Canada. So it means people who have moved to Canada from anywhere. And it happens to be that I had a couple of Australian clients, and one thing led to the next, and I ended up dealing with some tax professionals in Australia. And one Australian client led to the next, led to Facebook, etc. And now today I have quite a significant amount of Australian clients, who are based in Canada, or people who have tax interests in Canada. And although I'm not an Australian accountant, I do have a lot of familiarity with the Australian tax laws, and I do have professionals in Australia that I work together with.
Yeah, excellent. Plenty of Australians in Canada, so it's a great kind of niche, I guess, for yourself. Let's kind of get into some of the nuances of for our listeners to understand the Canadian tax system. So what are some kind of key differences between the Australian tax system and the Canadian tax system?
I guess the biggest difference that really causes a lot of headache for Australians in Canada is the different year ends. Whereas in Canada we're dealing with a calendar year end, December 31st is the tax year end. For whatever reason, in Australia your year end is June 30th, and that does, as we'll perhaps we'll talk about foreign tax credits, etc., causes a lot of headache for Australians in Canada. So that really is the biggest difference right off the bat. As well, in Canada, we have we have federal tax, and then we also have provincial taxation. So depending on which province you're in, the tax rates are actually different, from province to province. And you no longer have to file a separate return. Your federal return gets reported by the feds to the provinces, unless you're in Quebec. But there is different tax planning across the provinces based on different tax rates. So, and whereas I understand in Australia, you just have the federal taxation.
Yeah, that's exactly right. So you just file one tax return in Australia. We do have state taxes,
Mm-hmm.
which I guess are imposed through other methods. So we've got like stamp duty here in Australia, which is considered a state tax. So when you acquire property here in Australia, depending on what state you're buying that property in, that's kind of an example of a state tax, I guess you could
Mm-hmm.
say. But yeah, I know that Canada is in a similar taxes. The taxes there tax residents in a similar way that aliens in the United States kind of get taxed as well. You've got that state-based tax system as well. But that's interesting though. So you don't, because I know in the United States you file an individual kind of state tax return, but in Canada you just file a federal, and then it kind of gets accounted for depending on what state you're based in.
Right. It used to be that you were dealing with the province separately, but they kind of integrated the two together. But the truth is that the tax systems in Australia and Canada are really quite similar.
Mm-hmm.
I guess going back to the to the British tax system. So the truth is that at their core they really are quite similar.
Yeah, excellent. What would you say are kind of one of the biggest misconceptions for Australians that I guess Australians have about the Canadian tax system?
I would say a couple of points. I would say the biggest misconception is that you'll have an Australian who'll move to Canada. They'll say, okay, I have Australian income. I'm going to put down my Australian income. I'm going to put down my Australian taxes paid, and now let's see if I owe anything to Canada. Probably not, because they're claiming a foreign tax credit. What they don't realize is that there's a lot more involved to claiming a foreign tax credit, especially as we said, number one, the year ends are different. And CRA, the Canada Revenue Agency, they love to question foreign taxes. In fact, you claim a foreign tax credit in your tax return. I would say about 95% of the time, you're going to get a letter from CRA saying, okay, prove the foreign tax credits, show us your Australian returns, show us, tax, and the taxpayer will just, panic.
Yeah.
And it's usually done incorrectly because you're dealing with different year ends, and not only that, when you file your Canadian tax return, let's say you're filing in next year in April 26, you're going to file an Australian tax return. You won't even know how much Australian taxes you've paid in the second half of the year because you haven't yet filed your Australian tax for that second half for July to December. So CRA are not going to accept an estimate of taxes. So Australians get very, concerned. It can be quite alarming to get a letter from CRA saying, okay, we're going to deny your foreign tax credits, and they really, it hasn't been done correctly from the outset.
Yeah, absolutely. It can be a little bit alarming, I'm sure. So what do you tend to do there? Do you encourage Australians in Canada to make sure that their Australian tax return is filed first, and then you kind of look at their Canadian tax return? Or at least that would make it more simple.
Right. However, the chances are you're going to miss the tax deadline in Canada. So in an ideal world, that would happen. You would have filed both your Australian tax returns before you get into the Canadian taxes, but you're going to miss the tax deadline. You're going to end up, paying penalties. So what I usually do, and it depends on, from situation to situation, is I won't even claim a foreign tax credit for the Australian living in Canada if they have Australian income. We won't claim a foreign tax credit. We'll file without it, and it will cost them more tax. And then once the second Australian tax return has been filed, we'll go in and file an amended, an adjustment to the Canadian return and claim a foreign tax credit. That means that then when you receive the letter from CRA, okay, we now have the ammunition with what to respond to them. We now know the actual Australian taxes. We're no longer guessing at the Australian taxes. And now you have a chance, a high chance, hopefully, of your foreign tax credits being allowed. Whereas before, you're going to file for a foreign tax credit. They're going to ask you questions. You can't answer it. They're going to disallow it. And then you have to go and amend anyway. So let's just jump to step 2 and file without and then amend.
Sure, it makes much more sense in that manner. So you want to kind of file your Australian, well, you do your Canadian one, don't claim any foreign tax credits, then file your Australian one, and then you file for an amendment or make an amendment to that Canadian tax return.
Yeah, and it can cause, it depending on the numbers and the situation, it can cause a cash crunch, because remember, you're overpaying your Canadian taxes up front and then hoping to get it back. So there may be situations where it has to be done differently, but generally, that's how I would address the situation.
In an ideal world, sure. Let's get into, I guess, some of the more specifics of tax residency in Canada. So if I'm an Australian, I've moved to Canada, how do I determine if I'm a tax resident of Canada? I guess, how does the CRA determine if someone is a resident for tax purposes in Canada?
Okay, so there are very specific laws about tax residency. However, we'll see that really it's actually some of these things can be quite grey and really unclear. But pretty much Canada's going to look at the 2-tier system in terms of like where you most closely connected to, where is really your home, where is I'm using the term center of life. They don't actually use that term, other countries, but it really boils down to where do you consider your home to be. So, for example, originally they'll look at your significant residential ties. Where is your home, right? Where have you been living? Do you have a spouse in either country? That would help to determine where your residency is. Do you have dependents? You have children, for example, or perhaps have you come to Canada for let's say a year or two. That's really where you get into gray areas. So there's the initial ties we just discussed, and then there's more secondary ties where do you have property in either country? That could be a secondary tie, like where are your social ties, economic ties, like where are you more economically dependent? But it really boils down to where is your center of life. So as I said, it's a gray area. It can be quite a gray area. I'll give an example. Let's say you have an Australian, and there are a lot of Australians who move to Canada. They come on a working holiday visa, right? This is really a classic. A lot of young individuals come to Canada on a working holiday visa. They're going to be in Canada for 1 year, maybe 18 months, maybe 2 years. The question is, what is their tax residency, for that period? Generally, if their intention is to go back to Australia and they're in Canada for, let's say, a year, I would say that they are a non-resident of Canada and would remain to be a tax resident of Australia. But what if somebody comes for 2 years, 3 years? That's where you really get into a more gray area, and it really has to be determined case by case.
Yeah, absolutely, and it's very similar to here in Australia. It's very conditional, to determine tax residency. Here in Australia, the rules are very subjective. There are a number of factors that are considered about your personal circumstances that really determine tax residency. How does it work if you spend more than half the year in a calendar year in Canada? Does that then make you a resident for tax purposes in Canada?
So it does not. It's a factor. It doesn't mean that you're going to be certainly a tax resident in Canada. Yeah. Again, they would look at. In other words, it doesn't go by just the number of days, but that could be a significant factor. And it is possible that you could actually end up being a tax resident of both. In other words, Canada would say you're a tax resident of Canada, and Australia would say you're a tax resident of Australia. And then you'd end up having to look at the tax treaty between Canada and Australia. And they really have like tiebreaker rules. Like they'll go through like level 1, level 2, level 3, and try and determine, between the two countries. Because at the end of the day, you're only going to be a tax resident of one country. And the reason I think it's just important to point out, the reason why we're having the discussion about tax residency is because if you are a tax resident of Canada, you are therefore taxed in Canada on your worldwide income, right? And whereas if you're if you remain to be a tax resident of Australia and you're a non-resident of Canada for tax purposes, then you're only taxed in Canada on your Canadian source income. So let's say you have somebody comes for 1 year working in Canada. I have a lot of doctors, for example, they come, they do a fellowship in Canada for 1 year. They're really non-residents of Canada. They're only being taxed in Canada. They're going to file a non-resident tax return. They're only being taxed in Canada on their Canadian source income, which is, let's say, their employment income while they were doing the working as a doctor in Canada. And anything in Australia is not relevant to Canada. That will be taxed in Australia as part of their worldwide income in Australia.
Yeah, absolutely. And it just kind of speaks to the importance of understanding your tax residency in both countries. And if you're still a resident for tax purposes in Australia, it's likely your global income is subject to tax here in Australia. So understanding your tax obligations as a result of your tax residency is really critical.
Correct. Yeah.
Let's move away from the conversation on tax residency. I wanted to get your thoughts and your views on, I guess, for Australians that hold assets in Australia, and which many of them do naturally, and then they move to Canada. What are, in terms of understanding the tax implications on some of these assets in Australia? So if we look at income from certain Australian assets such as property or shares, how are these income sources subject to tax in Canada?
Okay, so yeah, that's a great question. It really applies to pretty much nearly every Australian that I've encountered. Australians love to hold on to their real estate, it seems, in Australia, and would often have investment portfolios in Australia still. So
Mm-hmm.
it really is a question that applies across the board. So if and again, this would all hinge on them being tax residents of Canada. Let's assume that they are tax residents of Canada, and therefore, as we said, they're taxed on their worldwide income. Worldwide income includes any rental income that you have in Australia or any investment income, dividends, interest from a portfolio or shares, whatever you have in Australia, because in Canada you're being taxed on your worldwide income. Now, however, those are, let's say, the property in Australia is for sure being taxed back in Australia still. So at that point, you have to get into foreign tax credits in Canada. Australia would get the first bite of that income because it's actually Australian source income. They would tax you on the rental income, let's say the net rental income. And then in Canada, you would have to report it as part of your worldwide income. And then you'd have to try and claim your foreign tax credit to say, listen, this is what I paid in Australia. Please reduce my Canadian taxes in Canada for that rental income. It's not a perfect system.
No.
There are some flaws in the system. You can end up with some extra taxation in Canada. And as I said, it's also very complicated to claim a foreign tax credit. But bottom line is, yes, you're being taxed on everything, including your Australian income, if you're a tax resident of Canada.
Yeah, absolutely. As you said, you're a tax resident in Canada, so you have to report your worldwide income. It's worthwhile. I'll point out as well for Australians living in Canada, your net rental income is subject to higher tax rates in Australia. They're subject to foreign resident tax rates. So you no longer, here in Australia, for residents, we have what's called the tax-free threshold, where the first 18,200 of your Australian sourced income is not subject to tax. Essentially, when you're a non-resident, you're subject to these foreign resident tax rates. You're not afforded this tax-free threshold. And essentially, the first 135,000 of your Australian sourced income is subject to tax at 30%. So I think it's important for Australian expats to note the tax that they're going to pay on this income in Australia, and then ultimately that can be used to some extent as a credit in Canada.
Right. The higher tax rates in Australia, because they are non-resident, actually may not be terrible, because it would then offset, depending on the tax bracket that they're in Canada, that may end up offsetting more tax in Canada. So if you have someone in a higher tax bracket, paying higher tax in Australia wouldn't matter to them, because it would just increase the foreign tax credit in Canada.
Yeah, exactly. And then what about shares? We touched on property. What about for clients that hold shares in Australia and they're selling these shares? What are the tax implications on capital gains in Canada on those kinds of transactions?
So the capital gain in Canada, and this actually is similar to real estate. The capital gains in Canada is completely different to whatever your capital gains is in Australia. And the reason is because when you move to Canada, any property that you have, which includes, let's say, investments such as shares or your real estate, is then revalued at the fair market value of when you move to Canada. So let's say you move to Canada and you have a property in Australia or a share portfolio that was worth $1 million, even though your cost base in Australia could be much lower than that, then you end up when you move to Canada, your cost base in Canada now becomes the fair market value, which is that $1 million on the date that you moved to Canada. So whatever capital gains, so let's say you end up selling shares when you're in Canada, whatever capital gains you're reporting in Australia may not be relevant for the taxable capital gain in Canada, and certainly not with real estate. It's important actually with real estate to have it valued as of the date that you move to Canada, because that will become your cost base and you will pay capital gains. You may pay capital gains depending on something, departure tax, and we'll get to that. You may pay capital gains on that, but you'll have a higher cost base because presumably your fair market value of when you moved will be higher than what you paid for the property in Australia.
Yeah, it's really interesting. It's like this deemed acquisition. You're deemed to have acquired these assets when you arrive in Canada.
That's right. I want to point out something actually important because anybody moving to Canada with these assets, such as a portfolio of shares or real estate, it's also very important that they remember to file a T1135 each year. T1135 is basically a statement of your foreign assets. That's for foreign assets. There's also a different form if you have a foreign corporation. If you have a corporation in Australia, there's another form if you have a trust in Australia. Trusts are quite common in Australia, actually, for anyone who has a business, for tax planning in Australia. So if you have foreign assets, a foreign corporation, and certainly foreign trust, then you have to file these other information forms. And the reason I'm saying it's so important is because the penalties on them are huge. You're looking at late fee penalties for each of those forms of $2,500 each year. So you can have someone turn around and after 5 or 6 years realize, well, hang on a second, I never filed this 1135. I've got a house in Australia, I never filed this 1135. You can be looking at, penalties of over $10,000 plus interest on the penalties. I had a client come to me and they were looking at, between these different forms, between him and his wife, of $40,000 of penalties just for not filing this information form. They had paid their taxes, but this is an information form. So it sounds very scary and expensive. Thankfully there is what is known as a VDP, the Voluntary Disclosure Program, whereby you have the ability to go to CRA, and this has to be that you go to them before they come to you, and say, listen, I never filed these forms. Please allow them to be accepted late without penalties. So that's something we've done a lot of those for clients who've come to us, with this hanging over their head. So that is something to remember, that there is possibly, hopefully the ability to avoid some of those penalties, but they are very severe, and it is something to consider if an Australian has these assets.
Definitely, it just speaks to the importance of keeping good tax compliance. So when you move to Canada, if the intention is to remain in Canada for some time, getting some tax advice in that first year and having a professional kind of guide you through your information and tax returns, particularly in that first year that they arrive.
Yeah, very much. Yeah.
We touched on property before. Many Australians love to hold on to their Australian property upon moving to Canada. In a scenario where an Australian expat is looking to, for whatever reason, they're wanting to sell that property in Australia, they're a tax resident of Canada. I can kind of speak to the Australian tax implications of that. But do you mind just giving the listeners an understanding of what happens from a tax perspective in Canada on the sale of an Australian property?
Right. So as we said, it's gonna be revalued. The property was revalued when you moved to Canada. So let's say the
Yes.
property was $1 million when you moved to Canada. Doesn't matter if you paid a few $100,000 for that property in Australia. The property was valued. Your cost basis was, let's say, $1 million when you moved to Canada. Let's say you sell it for 1.5. So your gain is that is you're taxed on a gain of $500,000 in Canada. However, again, you should be able to claim a foreign tax credit if there is taxes to be paid in Australia. It's possible that it could be there is or isn't, but there is opportunity for a foreign tax credit. I just want to point out also that I've had clients move to Canada. Let's say they moved and the fair market value of the property when they moved, let's say real estate was high. They moved, it was worth $1 million. They ended up selling that property for $900,000, right? So they actually ended up with a tax loss. Although they sold it at a gain in Australia, they ended up with a tax loss in Canada, and we were actually able to utilize that tax loss in different ways in Canada. You have to be careful because it is subject to scrutiny from CRA. Like,
Yes.
why does this person have a tax loss? But that can happen. It can happen that
Yeah,
property could
interesting.
go down, especially today. It could be that the property has gone down, and somebody could actually have a tax loss in Canada, but really have a actually have a tax gain in Australia.
Yeah, absolutely. And then they've got this tax loss or this capital loss that they can use to offset other capital gains on the sale of assets in Canada, essentially.
Correct. That is correct. Part of it could even be a business loss because it's actually,
Okay.
let's say it's a rental property in Australia. It's likely to be a rental property, right? They probably rented it
Yeah.
out. Then somebody could actually be a business loss, which could be used to offset regular income. But you have to look at each situation.
Yeah, absolutely. And we were kind of speaking earlier in the week about the main residence exemption here in Australia. So I think many Australians would be familiar with this capital gains tax exemption that they receive here in Australia on their home. So in a scenario for an Australian living in Australia where they're a resident for tax purposes, if they acquire a home, say for $1 million, they then decide to sell that property 5 years later. It's been their home for that entire ownership period. They can sell that property, not be subject to any form of capital gains tax on the sale of that property. So that's kind of how the main residence exemption works here in Australia. Interestingly, if you're an Australian expat, you owned your home for a period of time, you then decide to move overseas. So, say you move to Canada, and then at that point in time, you decide to sell your property. A really critical mistake that a lot of Australian expats make is they believe that they're afforded the main residence exemption on the sale of that property, when in fact, as a non-resident for tax purposes in Australia, you will not be afforded that capital gains concession. So that can be incredibly punitive for Australians that have held property for a long period of time before expatriating to Canada, as an
Hmm.
example. So that's really important for our listeners that, Australians living in Canada that they might hold property in Australia that was previously their main residence. And yeah, again, I mentioned those foreign resident tax rates in Australia that apply to non-residents. That capital gain on the sale of that property would be subject to those foreign resident tax rates. So not an ideal outcome, particularly if you're expecting the sale to be capital gains tax free, at least from the Australian perspective.
Correct. As you said, it is quite punitive, and that does not actually apply. That's a major difference the other way around. Whereas, so let's say you have somebody in Canada, lived in Canada in their principal residence for a number of years, and then let's say they've lived there for 10 years, then they move to Australia for 5 years, they would still be able to claim the principal residence in Canada for 10 out of the 15 years. So it would just be they would claim a percentage of the principal residence, but you would not lose it as opposed to what you're telling me from Australia. You would not lose it overnight by becoming a non-resident.
Yeah, absolutely. And I think the Canadian system, tax system in that manner is a lot fairer. I guess you could
Yeah,
argue.
yeah.
Moving away from property, if we talk about Australian superannuation, so for many Australians, they've spent, many Australian expats have probably spent a lot of their working life in Australia. In Australia, there is a mandatory, there's an obligation for your employer to contribute to your Australian superannuation fund. It's about 12% of your salary here in Australia. So many Australians would have an Australian superannuation fund. So it's interesting to understand how other countries kind of tax or potentially tax superannuation when different actions are made, such as contributing, withdrawing, and the like. When it comes to an Australian in Canada who has a superannuation fund, how is that taxed? If we look at maybe the year on year earnings to start with, is that something that's subject to tax in Canada?
So we'll start with the good news. The year-on-year earnings are not taxed in Canada because they're part of a foreign pension plan, a recognized foreign pension plan. That's the good news. The question is, should it go on a T1135, which is a statement of foreign assets? Generally, foreign pensions do not have to be reported on the 1135. There is some guidance from CRA, not official guidance, but some of their tax answers where they said that some of the Australian plans should go on an 1135, and I generally do put them on an 1135 just to be safe. So
And this is
that's
just more of
the
an information return.
that's right, that's right.
Yeah.
But the earnings are not taxed year after year.
Yeah, that's good. And I think for Australian expats, understanding that even though you're a non-resident for tax purposes, your superannuation isn't taxed in a different way. So the earnings within your Australian superannuation fund, they still receive this concessional tax rate. So the maximum tax rate is 15%. So the tax is withheld by the super fund on your behalf. You don't need to report this in your Australian tax return. Where the confusion can lay is in withdrawing from Australian super. So here in Australia, just to give some context for how it works here in Australia, once you're over the age of 60 and you're making withdrawals from your Australian super, so you've met what's called a condition of release. The most common one is attaining age 65. So as soon as you've attained age 65, you can access your super unrestricted. And the withdrawals after the age of 60 are tax-free. So that's really beneficial to Australians, and particularly why it makes such a good retirement vehicle, because these withdrawals are tax-free after the age of 60. How does that kind of work if an Australian living in Canada is making withdrawals? What are the tax implications in Canada in that scenario?
This is where the bad news kicks in that a withdrawal from the super is going to be considered by the Canadians as just a regular pension payment and will be fully taxed in Canada. So you're really looking at this Australian who moved to Canada thinking, I'm now going to be, at my retirement age, I'm going to be getting this super pretty much tax-free, and now will be taxed at the regular tax rates in Canada. And I have yet to see a way around that. Some people talk about bringing the pension, bringing one's pension over from a super to Australia. It may be possible, but you're still not going to end up avoiding the tax on withdrawing from the super fund. So that's really where the bad news kicks in. And I guess that's really, talk about punitive. That's punitive.
Yeah.
I don't understand the Canadian Australian tax treaty. I don't know why that's not addressed. But they
Yeah.
just look at pensions across the board. A pension from one country will be taxed in the other country. So it's
Yeah.
not
And it just
good
makes
news.
superannuation a little bit less attractive, for Australians living in Canada who are expecting to retire in Canada or live in Canada for a prolonged period of time. You need to kind of reconsider your strategy around super. Not saying you shouldn't contribute at all. There can still be some really great tax advantages and wealth accumulation strategies that can be employed using your Australian super.
Hmm.
But again, it comes back to understanding your circumstances. Do you expect to retire in Canada? This is probably a good segue into our next discussion, where there might be some more effective Canadian savings or retirement tools that Australian expats can use in addition to their Australian super. So on that note, are there any, what would you say are some of the really effective retirement savings tools or structures that Australians in Canada can utilize?
I guess the main one is an RRSP, Registered Retirement Savings Plan. RSP is very common across, in Canada. So you earn a salary in Canada, you create a certain amount of room in order to be able to contribute to the RSP. So let's say you contribute 10,000. Let's say you have a salary of $100,000 and you contribute $10,000 to your RSP that year. And again, it's capped as to how much you can put into the RSP. But let's say you do contribute $10,000, then that $10,000 will be a deduction from your taxable income. So your taxable income will be reduced by $10,000. You'll pay tax, on the $90,000 instead of $100,000. And the plan is that eventually you retire, you have this money in an RSP. Remember, unlike the super, RSPs are taxed when they are withdrawn. They end up coming into a RIF, which is like an annuity being paid out. And at that point, you're going to pay tax. And the hope is that when you're retired, you're paying a low rate of tax to withdraw from the RSP, as opposed to when you were working full time. The tax rate was likely significantly higher. So I guess the RSP is really the main pension plan. A lot of people have a similar kind of plan within their work. So that's an
Yes.
RPP, registered pension plan that would be within their work, but it works on the same basis as the RSP.
Yeah, absolutely. And it's interesting because there's some similarities with the RSP to super, Australian super, but also some core differences. So I think in terms of the similarities, obviously it's similar to super. Here in Australia, you can make contributions and claim the amount as a tax deduction. I guess the differences are on the taxation of the investment earnings within those structures. So as I alluded to earlier, the taxes within super are 15%, whereas for a RSP, they're actually tax deferred. So this provides kind of like a unique tax benefit.
Correct.
You're not taxed on your earnings, so that allows kind of
Correct. It
your
grows.
balance.
Correct. It grows tax. It grows tax free all the way until forever.
You withdraw.
Until you withdraw. Right. It's always tax free. There is also another plan. It's not a retirement plan, but it's also a very useful vehicle. It's a TFSA.
Yes.
Tax-free savings accounts, whereby again you have to build up room each year. So let's say an Australian moving to Canada can't suddenly put in $100,000 into this plan, but I think you build up room $6,000 to $7,000 a year.
Yes.
And this also grows tax-free. So you put money in there, you can invest inside of the TFSA, and it grows tax-free. Any capital gains will also be tax-free. And whenever you want, you take it out because you put in after-tax dollars, right? There's no deduction from your taxable income for any contribution. So you put in after-tax dollars and you take out after-tax dollars, and it's basically grown, hopefully, grown nicely inside the TFSA, also tax-free.
Yeah, very attractive. And unfortunately, we don't really have anything like this in Australia where you can get this, you're incentivized to invest and effectively you get tax-free growth. And that's kind of the difference between the TFSA and the RSP. The investment earnings ultimately are tax-free upon withdrawal, but you don't get the tax deduction, correct? Like you don't get a tax deduction for the contributions going in. And I understand, as you alluded to before, there's a lower cap, so you can only contribute 6,000-7,000 per annum, so it's hard to kind of grow a large amount of wealth, but I think it's something you should look at if you're expecting to be in Canada for the long term as a wealth and retirement savings tool.
Correct. And as you said, it really depends on how long you're going to be in Canada. So you can have someone, if someone's going to be in Canada, 1 or 2 years, is it worth starting with an RSP? possibly not. But it depends on their earnings and how much room they'd even be able to have to contribute to the RSP by the time they've left Canada. Was it even worth it? Maybe not.
Yeah, sure. Absolutely. Let's get into some of the considerations for Australians that have spent a bit of time in Canada and have decided they're going to come back to Australia, so that they're planning their move, repatriating home. What happens from a tax perspective when this happens? So when an Australian decides to make that move from Canada back to Australia.
Okay, so anyone who was a tax resident of Canada, right? So again, we're talking about somebody who was
Yes.
we're not dealing with non-resident, somebody who was a resident of Canada. There is upon departure from Canada, upon leaving Canada, you now become a non-resident of Canada. There is a deemed disposition, which gets a lot of newcomers to Australia, gets their backs up like, what's all this about?
Yes.
A deemed disposition means that your assets are deemed to as if you sold them, and you now owe tax to Canada. Basically, it's their last chance to tax you because you're gone, right? So any appreciation in value is going to be taxed in as part of this deemed disposition. There are a couple of exceptions. The two main exceptions to the deemed disposition is, number one, Canadian real estate. So if you have Canadian real estate and you leave Canada, that will not be part of the deemed disposition, basically because they still have the chance to tax you when you sell that, because the hard asset is still sitting in Canada. That's one exception. And the other exception is, if you were in Canada for less than 60 months, 5 years, then there's no deemed disposition on property that you owned when you moved to Canada originally. So let's say, for example, an Australian moves to Canada, they still have their house in Australia, they're in Canada for 4 years, and then they move back. There will be no deemed disposition on that house in Australia. However, that would also apply to shares as well. If you have a portfolio and you're in Canada for less than 5 years, there'll be no deemed disposition. But any shares that you have, let's say you're beyond that 5-year rule. You have a house in Australia. You've been in Canada for 10 years. It's gone up, let's say $1 million in those 10 years. Now you're going to pay a gain in Canada on the deemed disposition on the Australian property. You're going to have a gain in Canada of $1 million, which could cause you significant tax. That actually is quite disheartening, because it really is a double taxation, because this person is not selling their home. Let's say the person just keeps the home, moves to Canada for 10 years, moves back to Australia, and they have no intention of selling the property. Mm-hmm. You've now ended up paying a double taxation to Canada. You're paying capital gains on the deemed disposition in Canada, and there's no way to offset it with the foreign tax credit because you don't have any. You're not selling the property.
Yeah.
So it actually becomes like a double taxation when it comes to property.
Yeah, because essentially with that property in Australia, you might return to Australia and not sell that property right away, and you might not sell that Australian property for 5-10 years from the time that you return to Australia, and it'd be highly unlikely that you'd be able to use that tax that you've just paid to the CRA as a tax credit to offset your eventual tax liability in Australia 10 years later.
Exactly. The Australians would. I understand the Australians would not care about any tax you paid on that property. This is Australian property. If you happen to have paid a deemed disposition, well, that's your problem, and that's really where it becomes double taxation. Where you can possibly avoid the double taxation is on a share portfolio, because you could possibly liquidate the portfolio before you leave and trigger some, let's say, taxes, some taxes in Australia. It depends, capital gains there may or may not be, but there are more options to avoid the double taxation. Whereas the property in Australia, you might not want to sell it. And a lot of people won't want to sell it, especially if they're moving back to Australia. So there are ways about it for the share portfolio, but that's really the deemed disposition.
Yeah, and I mean, obviously the Australian property is much more illiquid, right? It's not easily saleable, and there are a
Yep.
lot of transaction costs that go into the sale of a property. So you're much less inclined to want to sell that property to try and save on some taxes because of the cost incurred in disposing of that asset. Whereas shares, there's absolutely some opportunities there. You can kind of get in and out of shares a lot easier, and the transaction costs in selling shares are a lot less. So there are absolutely some opportunities there where if you've acquired some shares as a non-resident for tax purposes of Australia, and you acquired those when you were in Canada, and you've been in Canada for less than 60 months or less than 5 years, and you're planning to return home, it may be wise to look at selling those shares so as not to be subject to that deemed disposition on your departure from Canada. And then as a non-resident, you're not subject to capital gains tax in Australia on the increase in value of those shares. So absolutely some planning opportunities there.
Correct. And again, this exception to the deemed disposition is only for foreign property. So let's say they have shares in Canada, and let's say a person has. It becomes quite complicated when a person, let's say, has let's say they have their own business shares.
Yeah, yeah.
So you can have your own corporation, and then let's say I have a lot of doctors, they practice through a corporation and they build up assets inside of their corporation, and suddenly they're leaving Canada and there's a deemed disposition of the shares of the corporation for which they paid nothing, and now there's a deemed disposition, and that can also end up being a double taxation because the money has to still come out of the corporation. Then there's a lot of planning that needs to happen around those sort of situations where somebody has their own corporate shares and is leaving Canada.
Yeah, absolutely. And I mean, this deemed disposition truly can create some headaches, particularly if you're not prepared for it. So again, just kind of reiterating the importance of kind of getting some tax advice, understanding where you stand before you make any significant moves, such as repatriating back to Australia.
Yeah, absolutely correct.
We might wrap it up there, Jonathan. This episode has been incredibly insightful. I really appreciated your insights and your knowledge to our listeners on today's call. So thanks so much for taking the time out today.
Yeah, Mitchell, thank you so much for having me on. I appreciate it. It was I hope it's very informative, and I do find these discussions do help people plan for their move to Canada and back, because it does give them an understanding of what's out there as opposed to just doing this cold without knowing what could hit them down the road.
Yeah, and I think it's really highlighted the differences in how Australia taxes certain assets and income, and how Canada taxes certain income and assets, and the considerations that Australian expats need to be mindful of.
Okay, perfect.
I mean, we'll wrap it up there. Thanks so much for your time today, Jonathan, and to our listeners, thanks for tuning in, and we'll see you in the next episode. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.